Hi, I'm Victor Dergunov. Welcome to the Financial Prophet. We have a very special show for you today. We're going to discuss markets, why they may have bottomed, and why there could be much more upside ahead now that we've had this healthy correction. I also want to tell you about my three favorite chip stocks. So please wait until the end. So last week, we discussed why the Trump tariffs seem so painful. And we also talked about why the bottom of the current correction may be close. So the low point may have occurred last Monday when the NASDAQ had a rather excessive 4% drop. When we have these constructive correction processes, basically it's crucial to take advantage of these situations in order to boost the outperformance in your portfolio. So the S&P 500 declined by 10% from the recent all-time high. Now, while this may or may not mark the official end of the correction, we are likely very close to a low point. Now, the level of fear in the market has basically just gone off the charts, with the fear and greed index hitting a 14 level, and the VIX surging to 30 last Monday. Also, I want to point out that while the S&P 500 has fallen by 10%, which is very significant, other major averages and crucial stocks have nosedived much worse. For instance, the NASDAQ 100 declined by 15%. The Russell 2000 crashed by 20%. And these are the small caps. These are the stocks that are supposed to do well in a domestic economy, potentially helped by tariffs. So, I mean, we had a massive correction in those Russell 2000 stocks that have a lot of exposure to the domestic American economy. Now, while these may seem like steep declines, they are reasonable corrections. We've seen even more considerable declines in many of the high-flying momentum stocks like Palantir, AppLovin, and many, many others, the quantum names, even the Mag 7 or the Mag 8, whatever you want to call them, and many other high-quality equities basically have gotten slammed recently. Let's just look at these Mag stocks. So Alphabet down by 21%, Amazon down by 22%. I'm talking about peak to trough declines, the recent peak to trough declines here. So 21 in Alphabet, 22 in Amazon, 33% in NVIDIA, 57% in Tesla, 31% in Broadcom, 22% decline in Meta, and a textbook 20% correction in Microsoft and Apple. So when we're looking at these mag stocks, we see 20% or more corrections across the board. So what is the takeaway here? Every one of these mag stocks has corrected by 20% or more, which is pretty incredible considering that we are in in an upward market. We are not in a confirmed bear market or anything like that. Yes, sure, we are seeing a correction, but within, still all the evidence points to this being a correction within a bull market, but having all the mags down by 20% or more is pretty remarkable because from a fundamental perspective, nothing has really changed. Donald Trump campaigned on this. We knew he was going to implement tariffs. We knew that the initial transition phase from the previous White House policies could create some transitory volatility. So why so many are acting as if the recent happenings are a surprise? It's a mystery to me. These are not surprises. Donald Trump campaigned on leveling the economic playing field with tariffs. Moreover, the president campaigned on reforming the government, so no one should be surprised about Doge and things of that nature. Meanwhile, arguably the best stocks in the world are now 20 to 30% cheaper, and in some cases more than 30% cheaper, which is once again just astonishing to me. Now, the current fears, this is another element that's just really eye-popping. The current fears are essentially paralyzing the market. It seems like the market is pricing in a very high probability for a recession. However, there seems to be a greater probability of a mild to a moderate slowdown, or is a recession now guaranteed? Because, this confuses me. The market is trading as if a recession or some kind of really considerable slowdown is almost guaranteed 80 or 90% for sure. That's how the market is trading here. That's how much fear is in the market. That's basically what the market is behaving like here. Now, is that rational? In my view, no, it is not. Because again, a recession, it's far from guaranteed. I've read reports recently, and in my view, there may be a 20 to 25% chance, maybe a 30% chance, but that seems like the higher end of the estimates, that there's about a 25 to 30% chance that we may see a recession in the next 12 months. Nonetheless, that leaves about, a 70 to an 80% probability that there will not be a recession in the next 12 months. So I like those odds, because if a substantial recession is not guaranteed, these market-leading stocks and other high-quality equities that have been brutalized during this decline, they just may represent excellent buying opportunities right now. Now, let's take a look at the technicals, because technically, we may have bottomed. So we're looking at the S&P 500 chart here. Despite the S&P only losing 10%, this has been an enormous market decline. What makes the recent drop so notable is that the market as a whole, it wasn't even overbought when the decline started. It appears like the market wanted to go for a breakout, but it broke down instead due to considerable tariff-related uncertainty, specific pockets of froth, and worse than anticipated data. These factors converged on the market rather unexpectedly. We did anticipate a post-inauguration hangover and a pullback, so it was anticipated, but the slowdown fears and much fear over the tariffs and some of these other elements, they converged rather rapidly, causing the market to break down. So now that we've seen this steep correction, the market appears considerably oversold and undervalued here. The RSI dipped below 30 for the first time since the 2022 bear market low. So the relative strength index was even lower in this decline than in the August panic-driven crash, which is, again, pretty remarkable. The CCI has been around negative 200 for weeks. So basically, this indicator is showing that the market has just been deeply oversold for weeks now. The full stochastic fell decisively below 20 and is now turning higher. So now this technical indicator is implying a shift to a more positive momentum is likely to occur soon. Now, I also want to note that the price action fell sharply below the 200-day moving average, illustrating deeply oversold market conditions and suggesting that a bullish reversal could occur soon. Now that we talked about the technicals, let's discuss just this enormous amount of fear in the market, because it's getting ridiculous now. There's the fear and greed gauge is at 21 now. While that's very low and it represents extreme fear, it's nothing compared to the 14 that we saw last Monday when, stocks were crashing and the NASDAQ had that epic 4% decline. So let's talk about the extraordinary level of fear in the market. While the fear and greed index shows 21, last Monday, the index hit a 14. Now you might be asking, wait, what, a 14? That is like the levels that we saw in the financial crisis of 2008. This is akin to something that we saw or we would see during the height of the coronavirus pandemic crash, before the market realized that there were vaccines. So this is the type of fear that we are dealing with here. This is just incredible. It's related with Donald Trump being the president or Elon Musk heading Doge. These are all, of course, topics for debate, but I'm sure that, these issues have something to do with it. And just the general amount of fear in the market, it's absolutely staggering. Again, is the current situation so grave that it justifies the current ultra high level of fear and anxiety in the market? In my view, no, it's not. And the market could come down soon, and we could have one hell of a rally very soon. But let's take a look at the VIX, because the VIX hit an ultra high level of 30 recently, also reflecting this extraordinary level of fear in the market. Now, every VIX spike and every VIX top is different, so don't let the August intraday spike confuse you in any way. The VIX just went absolutely bonkers that day. It hit like 50 or 55. When it was the height of the financial crisis in 2008, 2009, I remember the VIX, I think it topped at around 90, if I'm not mistaken, in 2009. So just so you know, the VIX can go very wild. If it's a constructive bull market, a 20 to a 30 level is very high, and typically it's unsustainable, and it signals that the market is going through a very typically brutal, but also often a healthy correction process, which is what I believe we are going through now. So the recent 30 level pop in the VIX was very significant. I also want to point out that the past year has been volatile, more volatile than your typical year, with numerous VIX spikes to 20 or 30. This dynamic, in my view, implies that the market could go through an extended period of calm a little bit later. When price action improves and when sentiment improves, I believe that the market could really go through a nice period of calmness, potentially prices melting up after this turbulent period passes, and it could pass soon. Let's talk about data a little bit, because data-wise, it's been pretty interesting what we've seen over the last month, and it should be very interesting what we see ahead. So The first thing I want to point out is that the recent jobs and inflation data were solid. So despite all this nervousness and all this volatility in the market, we are seeing relatively good numbers. Now, whether those numbers are going to worsen in future months remains to be seen as possible. But for now, we are really not seeing anything that alarming in my view. So the non-farm payrolls came in slightly lower than expected. The private non-farm payroll numbers, it only missed by 2,000, slightly lower than expected. So in my view, it was a Goldilocks reading. The unemployment rate ticked up to 4.1%. So we're still seeing a very resilient jobs market. We are just seeing a little bit of weakness, and this is good in the sense that the job market, it's not weakening so much that it's making investors really nervous, like there's a recession coming, but it's not that strong, so it's enabling the market to increase the probabilities for a future rate cut, which is very positive because it brings the Fed put back into the equation. So the job numbers look good. And now I also want to talk about the CPI, because the recent CPI inflation reading also came in better than expected. It was slightly lower. So we're hearing all this negative talk about tariffs and about inflation and about how inflation is going to go up. But the tariffs were never even taken down, some of the tariffs from Donald Trump's first administration. Joe Biden kept the Chinese tariffs on because they were beneficial to America, and other tariffs as well. So we have tariffs on now. We're going to have some more tariffs on, and we're seeing inflation moderate more. So this is really good, actually. A higher reading in the CPI, of course, would have reduced the probabilities for a future rate cut, so that would have been very negative. We also didn't want to see too much of a downtick, because then it would have brought in some concerns regarding the slowdown in the economy, whether the economy is cooling or inflation is cooling too quickly. So we got another Goldilocks read here. A 2.8 CPI instead of a 2.9. It's very good because the downtick provides a more significant probability that the Fed will cut rates sooner, especially if inflation continues coming down. And it should. Let's look at trueflation, because it's below 2%. And I know that the Fed prefers the core PCE, which is the gauge it refers to when it discusses its 2% target inflation rate. However, trueflation, which is a non-government real-time inflation gauge, shows inflation at around 1.7%, and recently it dipped to as low as 1.3 to 1.4%. So we've also seen energy prices, oil around $67, $68 a barrel, which is very positive for inflation. We've seen trueflation behaving really well. We've seen other inflation metrics pointing in the right direction. So instead of seeing an increase in inflation, we could see inflation decreasing instead, which is very constructive for the economy, and it should bring the Fed put back. And I also want to highlight that this dynamic goes against the high inflation due to tariffs thesis, as lower inflation could even out the possible impact on inflation from the tariffs as we advance in the future. Let's talk about the Fed, the potential for the Fed put coming back in the market. So there's about a 74% probability that we will see a rate cut by the June FOMC event. However, this probability was around 90% last Monday when the stock market was falling through the floor. Therefore, we've seen the probabilities for future rate cuts decreasing as we've seen some bounce back in markets, and we're really seeing quite a bit of fluctuations in the rate cut probabilities. Still, we've seen encouraging jobs, inflation, and other data, which could enable the probabilities for more rate cuts to increase. Now, I'd like to see the probability for a June cut to be about 90%, without the market tanking. So that would be, the preferred scenario in my view. Also, it would be advantageous to see the May rate cut probabilities increase. So currently the probability is only around 25% for a May rate cut. Now, in a more bullish case scenario, we could see the probabilities for a May rate cut increase to approximately 50%. And of course, it would be an excellent development to see the next rate cut in May. While this is still an unlikely scenario, the probabilities could increase, making a May cut a real possibility. So that would be really bullish. Also, this week is the FOMC meeting. While the central bank probably won't touch rates, the tone of the Fed chair and the level of dovishness or hawkishness could move markets in the near term. We want the Fed to acknowledge that there is considerable progress on inflation and that the Fed put will be back on the table sometime soon. Now, here's why there could be much more upside ahead. While many people seem overly focused on the perceived negative factors like tariffs, the Doge job cuts, this transitory market turbulence. Not enough emphasis is on the upcoming catalysts that could propel stocks much higher. So, in addition to the Fed's easing monetary policy, we should see substantial tax cuts, deregulation, fiscal spending, and other stimulus as we advance. So, in addition to the Fed's monetary stimulus, which will be the cutting of interest rates, as well as potential quantitative easing, we're also going to get a lot of stimulus from the White House, the Congress, and the executive branch. So we're going to see huge tax cuts. You know, we've been hearing about $5 to $11 trillion in tax cuts, which of course is massive, and that should be very good for the stock market. Then the deregulation aspect should be excellent for stocks. And of course, the targeted infrastructure spending, the fiscal spending, very good, very beneficial for American infrastructure, American jobs, American markets, and the stock market in general. Therefore, despite this near-term turbulence, which happens, it's normal, it happens every now and again. And I want to just highlight that this is a correction and it is a healthy part of any bull market. So despite this, there's a high probability for considerable growth for the economy and much more upside for high-quality stocks ahead. Valuations are relatively inexpensive, and we could even make an argument that many stocks may be cheap after these massive pullbacks. Now, I'm talking about Google, I'm talking about AMD, NVIDIA, I'm talking about so many stocks that have forward PEs of around 20 or below 20 now, which and have sales and EPS growth rates of 15, 20% or more, and are trading at 20 forward Ps or lower. These stocks are basically trading around PEG ratios of 1 or lower, and there are so many of these stocks. I believe that there are many excellent deals in the market right now, and we should be buyers here, not sellers. Furthermore, AI growth shows little signs of a growth slowdown, and we may see corporate profits continuing to increase. The dynamic for stocks is still bullish. That's the bottom line. So despite this transitory turbulence, I'm keeping my year-end SPX S&P 500 target range at 6,800 to 7,000. Okay, I want to thank you for watching my profit report, and I truly hope that you enjoyed it. Now, I promise to give you my 3 favorite chip stocks at the end of the show. So here they are. Number 1, surprise or no surprise, it's NVIDIA, because it's had a substantial 33% decline recently, and it is still the king of AI. Now, number 2 is AMD, and it is the cheap and underrated, under the radar second player in the GPU market. And I think it has a lot of growth ahead, not only in AI, but also in AI CPU and in consumer PC CPUs. And I think AMD is just completely underrated and overlooked here. So that is my second favorite chip stock for 2025. Now, number 3 is Marvell, ticker symbol MRVL. So this company is a custom accelerator maker for AI, and I think it has an excellent future ahead. Its stock just got cut in half recently, for no good reason other than it was just overbought. So an excellent buy here in my view for Marvell. I like the stock a lot. And just to make things interesting, I will add in a 4th chip stock, and probably this will come as of no surprise, but it is Broadcom, AI powerhouse, second only to NVIDIA in my view. It has the VMware segment AI division. So top quality software, top quality hardware, top quality services. What's not to like about Broadcom? It's another top play in AI. You know, I would love to hear some of your comments. So please join the conversation in the comment section below. If you like watching my video, please click share, like, and subscribe. You can also join the Financial Profit, my investment community, which is Seeking Alpha's #1 service for proven portfolio profits. We have more than 500 group members, and our amazing service keeps growing due to our consistent, stellar portfolio returns. Thank you very much for watching. I really hope that you benefited from watching my content, and have an amazing day. Thank you.